is Andrew, and welcome to Real Estate Basics. This is episode 2, and today we'll be talking about cash flow. So we'll get into why cash flow, why do I need to calculate it. We'll talk about what cash flow actually is and explain some common misconceptions a lot of people tend to have. We'll get into some of the thumb rules associated with cash flow calculations. And then I'll provide you with some examples on how to determine cash flow. And we'll talk about a common pitfall that some people might fall into. And at the end of the video, we'll go over the upcoming video topics as well as my real estate investing tips. So there seem to be a million different opinions of what cash flow actually is. You can go on any real estate forum today, whether it be the Bigger Pockets forum, the main one, or the Rookie forum, or the From Military to Millionaire forum. All these forums are on Facebook. You'll find people posting about their most recent deal or a deal they're thinking about. And they'll say, hey, look, here's my cash flow. And sadly, a lot of the times it's not true cash flow. And so that's why I want to help teach you today what true cash flow actually is so that you don't make the same mistake. Okay, so there are a lot of different factors that go into determining whether or not investment property is a good deal. And cash flow is one of those factors. So simply put, cash flow is your income minus your expenses. And this is typically on a monthly basis. So what goes into income? For short, and keep this example simple, it's rental income, whether it be from short-term rental or long-term rental. Every month, what you make in rent is your income. Expenses, first and foremost, is PITI, your principal, interest, taxes, and insurance. And if you have a condo and sometimes townhomes, they'll have an HOA or a regime or condo fees. Some newer housing neighborhoods have this as well, although it's typically a lot cheaper. If you decide to use a property manager to manage your property, take that into account as well. And this is where most people stop. And then they calculate everything and figure out what their cash flow is. I call this the quote-unquote cash flow. But it's not your true cash flow. Your true cash flow, you also need to account for reserves, aka the rainy day. Because guess what? At some point, your unit is going to have tenant turnover, and your unit is going to be empty. At some point, you're going to have to make repairs. And at some point, you're going to have to make capital expenditures. Now, what is CapEx for short for capital expenditures? These are your big ticket items, like replacing a roof, replacing the HVAC unit, or maybe a water heater. These are items that are going to cost you a lot of money, more so than your typical day-to-day repairs. So you have to take into account all of these reserves, in addition to all the other expenses for your cash flow calculation. All right, so the thumb rules, right? Remember, these are thumb rules. They're not exact science. And a lot of your personal comfort level goes into this as well. So you typically account for your reserves by taking a percentage of the total monthly rent. So vacancy is typically between 5 and 15%. And it's going to determine on things like, is it a long-term rental or is it a short-term rental? And what your market is like. Are you near, good sources of renters, such as a military base, universities and colleges, or maybe a big industry or a market. Maybe there's a bunch of hospitals nearby, or maybe there's a huge Amazon warehouse nearby. Something that's going to draw in a lot of people. If you're, on a long term with a good market, you probably only need to set aside 5%. If it's a short-term rental in the off season, then you might want to set aside 15%, maybe even more. For repairs, again, between 5 and 15%. That's going to determine on or depend on the age of the property, right? So an older home is typically going to have more things break. And same line of thought goes to CapEx, but you're going to look at specific items such as the roof, water heater, HVAC unit, and the age of those particular equipment. Right, so if the roof is 5 years old, well, you probably got 10 to 15, maybe even longer years left. So maybe you only need to set aside 5% each month. But if it's an older roof, like 20 years old, you probably want to set aside closer to 15%, if not more, each month for that inevitable cost. Okay, so an example, this is just a real basic example with thumb rules to show you how they apply. So some background for this example, it's a long-term rental in a well-established neighborhood, built in 1920. It was remodeled in 1960. We know the roof is 15 years old. There's no HOA and you're self-managing. And in this case, monthly rent is $1,000. So for vacancy, because it's a well-established neighborhood and it's a long-term rental, I would set aside 5% each month. For repairs, I know it's an older home. It was remodeled. Yes, not that recently, but it was remodeled at some point. I'm going to set aside 10% in this case. And I noted that the roof is 15 years old. So I'm going to set aside 10%, maybe even 15% of the monthly rent. Okay, let's get another example with a pitfall you might fall into. Same scenario, except this time your monthly rent is $500. Okay, so vacancy, again, 5%, repairs, 10%, CapEx, 10%. Everything's the same, except now your rent's different. Now you look at your CapEx and you're like, well, I'm setting aside 10%. That's $50 a month. That's $600 a year. But how much do roofs cost? Well, depending on the size of your home, it could be upwards of $10,000. Maybe more, maybe less. And if you're going to replace it in 5 years, well, 5 years times $600 a year is $3,000. Is that going to be enough to cover the roof? Probably not in this case. So that's something you're going to want to take into account when you're looking at these homes when you go to purchase them, particularly when you're doing your inspections. Take note of the age of this equipment because it can have a huge effect on your bottom line, especially if you're not careful. All right, now let's put it all together. Let's calculate cash flow. Okay, so similar scenario. Okay, except this case, the roof is a little older. It's 20 years old. Purchase price of this particular home was $150,000. I decided to use a conventional loan, non-owner occupied, so my lender required me to put 20% down. So I get $30,000 for the down payment, and the loan amount is $120,000. I'm able to rent out this unit for $1,400 a month. Let's go through the expenses. Let's assume I got a 30-year fixed rate at 3% interest on this $120,000 loan. That comes out to $506 a month for principal and interest. Taxes, right? This is going to depend on your market and your state. Every market has their own tax rate, so that's something you're going to have to determine. And be careful because some states like to charge extra taxes for short-term rentals. And they also like to charge extra taxes just because it's a rental and because you don't own it and live in it personally. So just be mindful of that when you're determining what your taxes are going to be each month, because every state is different. Insurance, again, is dependent on the property type, the value of the property, and the market. For argument's sake, let's say it's $100 a month. And this is what makes up your pity. Now let's get into your reserves. Right, remember, I don't have an HOA and I'm self-managing here, so I don't need to take those into account. So there's your vacancy, 5%, repairs are 10%, and CapEx is 10%. Let's put everything into the equation, and your cash flow comes out to be $249 a month. Now this is true cash flow because you're also taking into account your reserves. This is what you want to see. This is a good number. What you don't want to see is, something that's $500 a month, but then you didn't take into account vacancies, repairs, or capex. But wait, I have questions. What are your questions? Oh, well, this month I didn't have any repairs, vacancies, or capital expenditures. So what do I do with that money? My recommendation is you put it into a separate account, like a savings account or a high yield savings account, something where it's liquid and you can get to it easily. I recommend you don't put it into the stock market, and especially don't put it into crypto because of the volatility. You could put all your money in there that you're saving up for a rainy day, and then it loses half its value. Then you're out of luck. But two, you want to be able to access this money rapidly. And in a savings account, high yield savings account, you can do this. This is personally what I do with mine. Reserves. Another question comes up is, okay, so let's say I do this every single month. I put it into this savings account. Do I just keep putting aside, 5 to 15% each month for 30 plus years? And this really depends on what you're comfortable with. Some people do. Other people will build up maybe 6 months worth of expenses, maybe a year's worth of expenses, and then they're comfortable enough with that then they'll take the extra money and apply it towards future investments. Another question that comes up a lot is, should I buy a property if I figure out it has a negative cash flow? Let's say, for instance, negative $100 a month, right? So instead of making you money each month, you have to pay $100 each month. And the answer is it's going to depend. Are you able to afford paying that negative cash flow each month? This house is for $200,000, but it cash flows negative $100 a month. Is it worth it to you? Can you afford that? Another thing you might want to take into account is, do you expect this property, because of the market, to have high appreciation within the next few years? In which case you might want to think about selling it. And that's your goal. Well then, sure, negative cash flow is fine. But again, it's gonna depend on you, your situation. Maybe you have a stable, well-paying job that you're not planning on leaving for the next 5, 10, 15 years. And you're okay eating $100 a month. For others, that's not okay. So it really just depends on you personally. Okay, some upcoming video topics. Okay, the next video we're going to get into cash on cash return, and we'll talk about what is considered a good return. And then I'll show you my combined cash flow and cash on cash return calculators within Excel. And again, I'll have one for single family, one for multifamily, and one for short-term rentals. And then we'll tie in cash flow, we'll tie in cash on cash return, and a slew of other topics that you need to keep in mind when analyzing a single family home. So we'll tie all that into one video. We'll talk about what is a good cash on cash return, what is a good cash flow value per month, in combination with these other factors. Then we'll get into the tax advantage of owning real estate and how owning can actually save you money. And after that, we'll get into what are the different real estate investing strategies that are available. Believe it or not, there are a lot. I learn about a new strategy just about every time I listen to a Bigger Pockets podcast. It's incredible how many different ways there are to get into this game. All right, now for my real estate investing tips, right? Remember, real estate investing, it's a get rich slow game. In my opinion, you have to have 3 things to be successful. You have to have patience. You have to study. And at the end of the day, you have to take action. If you study for a year and you have all the patience in the world, but you never take action, you're not going to be successful in the real estate investing world. And that's all I have for this one. So in closing, remember, cash flow is your income minus your expenses on a monthly basis, and don't forget about those reserves. If you like this content, please like and subscribe, and I'll see you next time. Take care.